Hello, I'm Anderson Cooper. Tonight we are looking at something that affects millions of Americans. It is not a new law from Washington. It is not a foreign conflict. It is a force inside each of us. This force can build fortunes. It can also destroy them. We are talking about emotion, how your feelings can secretly sabotage your financial future. Many people believe investing is about numbers, charts, company reports. They think it is a game of logic. But the truth is often more complicated. The real battlefield is not on Wall Street. It is inside your own mind. This topic matters more than ever. We live in a world of constant information. News alerts flash on our phones. Market tickers scroll across our screens. This endless stream of data triggers powerful emotional responses. Fear can spread in an instant. Greed can surge on a single headline. These feelings push people to make rash decisions. They sell when they should hold. They buy when they should wait. These mistakes have real consequences. They can delay retirement. They can shrink a college fund. They can turn the dream of financial security into constant anxiety. So, what exactly is emotional investing? It is the act of making financial decisions based on feelings rather than on a rational analysis of the facts. Imagine the stock market takes a sudden dive. The headlines are filled with words like crash and panic. Emotional investing is the impulse that tells you to sell everything right now, to stop the bleeding. Conversely, imagine a new technology stock is soaring. Everyone is talking about it. You hear stories of people making incredible profits. Emotional investing is the urge to jump in and buy, driven by a fear of missing out on the gains. These decisions are often made quickly. They are reactions, not strategies. They are rooted in some of our most powerful and primitive emotions. Fear is perhaps the most dominant. The fear of losing money is a potent motivator. It can cause an investor to sell their holdings at the very bottom of a market downturn, locking in their losses and missing the eventual recovery. This single act can be devastating to long-term growth. It turns a temporary paper loss into a permanent, real-world financial setback. Fear whispers that you need to get out now, before things get even worse. On the other side of the emotional spectrum is greed. Greed emerges during market booms. It is the intoxicating belief that you can get rich quick. It pushes investors to chase hot stocks, often buying them at inflated prices after most of the growth has already occurred. Greed makes people forget about risk. It encourages them to concentrate their money in a single speculative bet, hoping for a lottery-like payout. When the bubble inevitably pops, those who were driven by greed are the ones who suffer the most significant losses. Greed promises a shortcut to wealth, but often leads to a dead end. To understand why we make these errors, we need to look at the science behind our thinking. Psychologists. Behavioral economists have identified common mental shortcuts and errors known as cognitive biases. These biases are not signs of low intelligence. They are part of our shared human wiring. One of the most powerful is loss aversion. The principle is simple. For most people, the pain of losing something is psychologically about twice as powerful as the pleasure of gaining the same amount. Losing $1,000 feels much worse than gaining $1,000 feels good. This intense fear of loss has profound effects on investor behavior. It can make people overly cautious, causing them to avoid the stock market altogether and miss out on decades of potential growth. They keep their money in low-yield savings accounts, where its purchasing power is slowly eroded by inflation. For those who do invest, loss aversion can trigger panic selling. When a stock or a fund drops by 10%, the pain can feel so acute that the investor sells just to make the feeling stop. They are not thinking about the company's long-term prospects. They are reacting to the immediate emotional sting of the loss. This bias explains why so many investors end up selling low. The market is inherently volatile. Declines are a normal and expected part of the investment cycle. However, to a brain wired with loss aversion, every dip feels like a permanent disaster. The impulse to prevent further losses becomes overwhelming. An investor might sell a solid, well-run company's stock after a minor dip, only to watch in frustration as it recovers and climbs to new highs in the following months. By trying to avoid the short-term pain of a paper loss, they have locked in a real loss and forfeited future gains. Another powerful psychological trap is confirmation bias. This is the natural human tendency to search for interpret favor recall information that confirms our pre-existing beliefs or hypotheses. At the same time, we tend to ignore, devalue information that contradicts our beliefs. We all do this. We seek out news sources that align with our political views. We prefer to spend time with people who share our opinions. In investing, this bias can be particularly costly. It creates an echo chamber that reinforces our decisions, whether they are good or bad. Imagine you have just purchased shares in a company. You are excited about its potential. Confirmation bias will now subconsciously guide your research. You will find yourself clicking on articles with headlines like, "Why XYZ Corp is poised for explosive growth." You will pay close attention to analyst reports that have a buy rating. You might join an online forum where other enthusiastic shareholders share positive news and speculation. Each piece of confirming evidence provides a small hit of dopamine, a chemical reward that makes you feel good about your decision. You feel smart and validated. The danger, of course, is what you are not seeing. While you are busy collecting positive reinforcement, you are likely ignoring the warning signs. You might scroll right past an article titled, "3 Major Headwinds Facing XYZ Corp." You might dismiss a critical analyst report as being written by someone who just doesn't get it. If a friend raises concerns about the company's high debt load, you might become defensive and tune them out. Confirmation bias effectively puts blinders on you, preventing you from seeing a complete and objective picture of your investment. This creates a dangerous feedback loop. This can lead you to hold on to a losing investment for far too long. The third major psychological bias we will examine is known as herd mentality. This is the tendency to follow the actions of a larger group regardless of their own independent analysis. It is a social instinct with deep evolutionary roots. In the wild, staying with the herd meant safety from predators. In modern finance, however, following the herd can lead you straight off a cliff. When you see a large number of people buying a particular stock or asset, it creates a powerful sense of social proof. The thinking goes, if everyone else is doing it, they must know something I don't. This instinct is responsible for creating speculative bubbles. Think of the dot-com bubble in the late 1990s, or the more recent frenzies around certain cryptocurrencies, or meme stocks. The story is often the same. An asset begins to rise in price. The media picks up on the story. You hear about friends, neighbors, colleagues making quick, easy money. The fear of missing out kicks in. It feels like a party everyone was invited to but you. So you jump in. You buy, not because you have researched the underlying value, but simply because everyone else is buying. The problem with herd-driven investing is that the crowd is often wrong. By the time an investment becomes a popular craze, the price is typically already inflated far beyond its intrinsic value. The early investors, the ones who did their research, have already made their profits. The people who join the herd late are the ones who provide the exit liquidity for the early investors. They are left holding the bag when sentiment inevitably shifts and the price comes crashing down. Knowing about these emotional traps is the first step. The next step is building a defense against them, You need a system that separates your decisions from your feelings. The cornerstone of this system is a written investment plan. This is not a complicated document. It is a simple set of rules you create for yourself during a time of calm and clarity. This plan should clearly state your financial goals. Are you saving for retirement in 30 years? A down payment on a house in 5 years? Your timeline is one of the most important factors in your strategy. Your plan must also define your risk tolerance. This is an honest assessment of how much volatility you can stomach without panicking. Are you comfortable with the potential for large swings in value for the chance at higher long-term returns? Or do you prefer a slower, steadier path, even if it means lower potential gains? There is no right or wrong answer, but you must be honest with yourself. Once you have defined your goals and risk tolerance, you can create a target asset allocation. This is simply the mix of different investments, like stocks, bonds, cash. Once you have this plan on paper, you must commit to following it. This document becomes your anchor in an emotional storm. When the market is soaring and you feel the pull of greed, you consult your plan. It will remind you to stick to your target allocation, perhaps by selling some of your winners to rebalance. When the market is crashing and you feel the grip of fear, you consult your plan. It will remind you that downturns are normal and that your long-term strategy was designed to withstand them. The plan acts as a rational barrier between an emotional impulse and a rash action. Part of your plan should also involve developing emotional awareness. This is where the practice of mindfulness can be incredibly valuable. It is the simple act of noticing your feelings without judgment and without an immediate need to act on them. Before making any trade, take a moment. Pause. Take a deep breath. Ask yourself, why am I doing this? Is this decision aligned with my written plan, or is it a reaction to today's news? Is it driven by fact or by fear? This small gap you create between feeling and action is where rational thought can take over. It is a moment of power that can save you from your worst impulses. Beyond a written plan, there are two powerful practical tools that can help you build a fortress against emotional investing. The first is diversification. The old saying, "Don't put all your eggs in one basket," is one of the most fundamental truths in finance. Diversification means spreading your investments across a wide variety of assets. This doesn't just mean owning 20 different technology stocks. It means owning different types of assets that tend to behave differently under various market conditions. This includes a mix of stocks and bonds, domestic and international companies, large and small corporations. The purpose of diversification is to smooth out your returns and reduce the impact of a single bad outcome. If all your money is invested in a single company and that company fails, you lose everything. But if your money is spread across hundreds or thousands of companies in different industries and countries, the failure of one or even several of them will have a much smaller impact on your overall portfolio. Diversification is your defense against overconfidence and the temptation to bet it all on one sure thing. It is an admission that you cannot predict the future. The second powerful tool is automation. Automation is the process of putting your investment strategy on autopilot. The most common way to do this is through a strategy called dollar cost averaging. This simply means investing a fixed amount of money at regular intervals, such as every month, regardless of what the market is doing. You can set this up through your workplace retirement plan or with a brokerage account. An automatic transfer moves money from your bank account and invests it according to the asset allocation you defined in your plan. Automation is a brilliant defense against emotional decision-making. It removes you from the equation. You are no longer deciding when to buy. The decision is made for you by the calendar. This system forces you to buy more shares when prices are low and fewer shares when prices are high, which is the exact opposite of what our emotions of fear and greed tell us to do. It prevents you from trying to time the market, a strategy that fails for the vast majority of investors. By automating your contributions, you commit to a disciplined, long-term approach, insulating your strategy from the daily noise of the market. When we look for examples of calm, rational investing, one name consistently rises to the top: Warren Buffett. The chairman of Berkshire Hathaway is one of the most successful investors in history. His success is not built on complex algorithms or frantic day trading. It is built on a foundation of disciplined patience and a profound understanding of emotional control. Buffett is famous for his simple advice: be fearful when others are greedy and greedy when others are fearful. So I will leave you with a simple task. Right now, take a moment to reflect. Start today.